Good evening everyone, and welcome to this webinar on the new financial reporting requirements for small charities. My name's Julia Fletcher and I'm the Financial Accountant for Charities Services. I'll be joined shortly by Amy Lewin from the External Reporting Board to take you through this presentation. It's great to see so many of you have joined us this evening. We welcome you to ask questions during the session. If you're not familiar with webinars, you do this by asking it through the control panel, which is on the right-hand side of your screen. There's a question button. Just type your questions in as they come to mind, and we'll answer as many as we can at the end of the session. If we don't get to your question today, then you could have a look at the frequently asked questions on the External Reporting Board website or the resources on the Charities Services website in the first instance. And we will be publishing a collated version of all the questions asked today soon after the webinar. If at any time during the session you experience sound problems such as an echo or feedback, if it persists, you might consider using your phone instead. Just select the telephone option and dial into the audio. Enter the access code and audio pin when prompted. These are provided right there on the panel. You might want to also have a look at our handouts. They're also on the control panel on the right-hand side under the tab that says Handouts. Just click the plus sign and you'll be able to see a PDF version there. You might like to print those out and take notes while we're going. Before we get started on the material, we're firstly joined by Sarah Doherty, who's the Regional Advisor at Charities Services, and Warren Allen, Chief Executive of the External Reporting Board, who are going to speak to you briefly on why we are undertaking this process of change and the importance of the new financial reporting standards for us as a nation.
Thank you, Julia. Kia ora koutou. As Regional Advisor, I've had the privilege of presenting seminars to many hundreds of charities in person, so it gives me great pleasure to join you this evening in this digital space. From Charities Services perspective, we're really pleased that accounting standards for charities have been developed because we see that those standards will enhance the quality of reporting for charities in New Zealand. Up until now, there have been no minimum standards for charities' financial reporting, and this has resulted in a very wide range of quality. The clarity and consistency that the new standards will provide will mean that people reading the performance reports of charities will be able to make better decisions. And as well, we will be able to collect more useful data about the sector as a whole. This data will help to inform government when it's making decisions that impact on the sector. The standards will also help to support more effective governance internally, as charities will be more able to clearly articulate their purpose and measure their progress from one year to the next. Together, better quality reporting, more accurate data, and stronger charities help to make New Zealand a better place for New Zealanders. So I'm delighted that we're able to share this knowledge with you today. Thank you for taking the time to learn with us this evening. I'll pass over now to Warren.
Thank you, Sarah. Good evening, everybody. I'm Warren Allen. New Zealand's 27,800 charities add significantly to the quality of life in this wonderful country of ours. A considerable percentage of our population donate resources, including money and time, for charitable activities. We have witnessed a mammoth global change in the donating public, requiring higher levels of accountability and transparency relating to the use of their donated resources. Therefore, to maintain the vibrancy of New Zealand's charities, the compliance with these new accounting framework is critical. It may take a couple of years for high levels of compliance to be achieved, but it is now essential to be aware of the change, give it your best attempt, Pay attention to the detail and learn from others to improve upon the first year's effort. There are many avenues of help available to you. Accountants and those that keep the financial records for charities are vital to ensure the benefits of this change are fully delivered. I trust this webinar encourages you to embrace the change in charities financial reporting and gives you the opportunity to add real value to the charities you serve. Thank you from me for joining us for this webinar and all the very best. And it's my pleasure now to hand you back to the capable hands of Julia.
Thanks very much, Sarah and Warren, for setting the scene as to why this is such an important change for charities in New Zealand. So now let's get started with the material. The new accounting standards for Tier 3 and Tier 4 entities have been written with the intention that both accountants and non-accountants will be able to follow them. Therefore, the main objective of this webinar will be to ensure you come away with a high level of understanding of what has changed and what to look out for. So our presentation will include a broad overview of the standards framework within New Zealand and the way changes for charities are part of the financial reporting review that has been underway during the past few years. The key aspects of the not-for-profit reporting standards that are different from older reporting standards, and we'll go over the new assurance requirements for charities as well. Remember, if we haven't gone into enough detail for you by the end of the presentation, you can always refer to the standards directly. I'm now going to pass over to Amy from the External Reporting Board, who is going to explain to us how we have arrived at this point and how it all fits together.
Thank you, Julia. Good evening, everybody. Thank you for taking the time to join us. It's great to see so many of you watching this webinar. My name is Amy Lewin. I'm the Project Manager of Accounting Standards at the External Reporting Board. The Financial Reporting Act 2013 was updated at the end of 2013. All you need to know about this Act is that it gives the External Reporting Board, or the XRB for short, the mandate to set financial reporting standards for a number of for-profit and not-for-profit entities, including registered charities. The other significant Act that was passed was the Financial Reporting Amendments to Other Enactments Act 2013. This Act amends a raft of legislation, such as the Charities Act 2005. The effect of which is to specify which entities need to prepare financial statements in accordance with the XRB standards. In your case, all registered charities have to apply our standards for periods beginning on or after 1 April 2015. This is in Section 42A of the Charities Act 2005. In New Zealand, we now have a multi-sector, multi-standards framework. This means we have different standards for the for-profit and public benefit entities. Public benefit entities, or PBEs for short, is defined as reporting entities whose primary objective is to provide goods or services for community or social benefit, and where any equity has been provided with a view to supporting that primary objective, rather than for a financial return to equity holders. A for-profit entity is an entity that is not a PBE. So you're watching this webinar because the entity that you're involved with is a registered charity and by definition is likely to be a public benefit entity. There are 4 tiers of reporting requirements. The tier structure was developed to match the benefits with the costs of preparing general purpose financial reports. As you go down the tier, the smaller the entity, the obligations become simpler and thus the compliance cost is reduced. The standard is different based on the tier that you're in. This webinar is for charities with operating expenses of less than or equal to $2 million. So this is either Tier 3 or Tier 4. Not all registered charities are the same. Approximately 97% of registered charities have operating expenses of less than $2 million. We developed the 4-tier accounting standards framework largely based on the size of the charity. Size here is based on the charity's operating expenses or operating payments. The Tier 3 and the Tier 4 standards are much simpler than the Tier 1 and the Tier 2 standards and considerably smaller in size. They were written with non-accountants in mind, so that it is less technical than the accounting standards that you may have read in the past. The Tier 1 and the Tier 2 requirements comprise 38 standards and 1 authoritative notice, being the PBE conceptual framework. So in total, these standards are over 1,000 pages long. So if you compare this with the Tier 3 standard, the requirements are approximately 40 pages. The Tier 4 standard is even smaller, with only approximately 18 pages of requirements. The Tier 3 and the Tier 4 standards are based on research of the transactions that not-for-profit entities commonly enter into. So we didn't develop these standards without the proper research. If you elect to report under a particular tier, then you need to apply the requirements for that whole standard. You can't pick and choose requirements from different standards. There are 2 sets of public benefit entities standards, one set for the not-for-profit entities and one for the public sector entities. So if you are a public sector entity, then you'll need to apply the public sector version. If you are a public sector entity and a registered charity, please speak to the Office of the Auditor General on the appropriate version to apply. The criteria for Tier 3 is total operating expenses of less than or equal to $2 million. Total expenses is determined for the whole charity or the group where there is a group for financial reporting purposes. In very simple terms, a group is where there is a main charity, like a head office, that controls another charity or entity for financial reporting purposes. This other charity could be a branch. Control here is a very specialized term used in financial reporting. If you think you could be in this situation, please seek professional advice. To qualify for Tier 3, total operating expenditure for the whole charity or group is less than or equal to $2 million. Operating expenses are your day-to-day expenses. So they include costs of fundraising and any grants that you make to another charity or another entity. Expenses also include reductions in the value of property, plant and equipment. This is called depreciation expense. It's all your outflows that you incur during the year, but it excludes capital outflows or purchases. So examples of capital outflows are repayments of borrowings and the purchase of fixed assets. These are not operating expenses. Tier 3 charities apply accrual accounting. Accrual accounting is where transactions are recognized when they are earned or incurred. Transactions are made for the year-end debtors and creditors. Accrual accounting also includes depreciation if you have fixed assets. The Tier 4 criteria is total operating payments of less than $125,000. Operating payments are your day-to-day expense payments. Operating payments do not include capital payments. So for example, if your charity pays $10,000 for a motor vehicle, this is a capital payment and is not included in the operating payments total. If your charity invests $10,000 in a term deposit, this is not included in operating payments. This is just a transfer of money to another bank account. Tier 4 charities apply cash accounting. So under the cash base of accounting, transactions and other events are recorded when the cash is received or paid. Cash accounting does not include depreciation because this is not a cash activity. So if you currently do depreciation or accrual accounting and you want to continue to do so, you can elect up to Tier 3 and apply accrual accounting. You always have the choice to opt up to a higher tier of reporting. The official title of the Tier 3 standard is Public Benefit Entity Simple Format Reporting Accrual Not-for-Profit. This is quite a mouthful, so for simplicity we will refer to this as the Tier 3 standard. So as already mentioned, the Tier 3 standard is a accrual-based standard. Revenue and expenses are recorded when they're earned or incurred, rather than when the cash is received or paid. Financial statements prepared under the accrual basis include adjustments for the timing of revenue or debtors. It also includes items such as debtors, which is money owed to the entity, creditors and accruals, money owed by the entity, and depreciation. Financial statements prepared in this manner more fairly represent the financial performance and financial position of the entity. We've also developed an explanatory guide. So this explanatory guide is written in more plain language than the standard and is designed to be even more user-friendly. The guidance notes include tips and highlight important pieces of information, has examples, and it cross-references back to the standard. In addition to the explanatory guide, we have also developed templates. These templates are optional, but if you complete them correctly, it will meet the requirements of the standard. The templates are designed to cover most circumstances, but not everything. So if there are matters that are significant and necessary to include for users of your performance report, which are not provided for in the template, then further detail should be given by means of additional notes. If there are things in the template that are not applicable to your charity, then they can be removed. The templates are in PDF and Excel format and are available from both Charity Services and the External Reporting Board's website to download. The official title of the Tier 4 standard is Public Benefit Entity Simple Format Reporting Cash Not-for-Profit. Again, for simplicity, we will refer to this as the Tier 4 standard. So this standard is under the cash basis of accounting. Transactions and other events are recorded in the performance report only when the cash is received or paid. For most entities, this will involve taking their cash book and summarising the receipts and payments for the financial year. The Tier 4 standard also has an explanatory guide. This is EGA 6 and optional templates. So if you find the standard a bit daunting, then start with the templates and the explanatory guide. Then you can refer back to the standard if both these documents are not clear. So this is the External Reporting Board's homepage. You have your own purple button on our homepage. So by clicking on the purple button, you will get to all the standards, explanatory guides and templates for all the tiers for the not-for-profit entities. So rather than clicking on the purple button and then scrolling down to find what you need, to make it easier for you, we have developed quick links to the Tier 3 and Tier 4 templates. And this is on the right-hand side of our web page. And this is where the arrow is pointing to. When you get to the templates, above these are the explanatory guides and the standards. We also have quick links to the frequently asked questions that Julia mentioned earlier. I'll now pass you back to Julia, who will go through some of the requirements of the Tier 3 and the Tier 4 standards.
Thanks very much for that, Amy. Just before I continue on, we've got a few questions coming through at the moment, but please ask us questions, because you can guarantee if you've got a question on your mind, there's several other people who also have that same question, and we'll have plenty of time at the end of the session to go through lots of questions. But don't worry, I won't read out your name, so you can remain anonymous. So we've now had a look at the thinking behind the standards, so let's have a closer look at what makes up the performance report. You will recall that the Tier 4 standard uses cash accounting and is for organisations with less than $125,000 annual operating expenses. So what does the Tier 4 performance report actually include? You can see from the diagram there are several parts to the report. It includes both non-financial and financial information, as well as some further supporting information when that is helpful. Overall, it is designed to show simply why the charity exists, what it has been busy doing, and how the money came in and out. Under the Tier 4 standard, the profit or loss and the cash flow statement are combined, and this becomes the statement of receipts and payments. This literally shows all the transactions in and out of the bank account, divided between operational and capital transactions. It is then reconciled to the bank balance. Instead of the balance sheet, you have a statement of resources and commitments. The key thing to note with this is that it is simply a list of the significant things the charity owns or owes. It does not include any retained earnings, and it does not need to balance. One reason for not including a balance sheet is that the cash standard has been written for very small organisations with very few transactions and potentially limited accounting expertise. The notes to the performance report include the accounting policies, which includes stating the standard that has been followed and the GST treatment. Remember that Tier 3 is for organisations with less than $2 million annual operating expenses. You can see that the Tier 3 performance report is similar but different. Again, it is designed to tell the whole story of the organisation. So it includes non-financial information to set the scene and provide the context, followed by financial statements. The financial statements are different because Tier 3 uses accrual accounting, and there is also a cash flow statement included. To be clear, this shows the cash movements in and out of the organisation over the past year. It is not a projection of cash flows or a budget for the future. The cash flow statement shows quite clearly whether more money came in than went out during the year. Tier 3 is also designed to show simply why the charity exists, what it has been busy doing, and how the money came in and out. We'll talk a bit more about the non-financial information first. This comprises the entity information, who we are and why do we exist, and the statement of service performance, what did we do and why those activities. The purpose of including the non-financial information in the performance report is to tell the story of the organisation. It's that story that engages people to want to volunteer or donate. It's also an ideal avenue for funders to see the overall mission of the charity. Providing the entity information and the statement of service performance sets the context for the financial reporting, shows the awesome work that is done, and this document could also be used to showcase your charity. The performance report is publicly available on Charity Services website, and we have about 44,000 hits a month. So that means members of the public, funders, media, and other stakeholders are looking, and therefore it makes sense to put your best foot forward when preparing your report. If you pair financial and non-financial information together, you can see the amazing work that charities have achieved and understand their purpose a lot better. I'll explain this with an example of one performance report I recently read. We received an annual return from a wildlife charity, and they submitted a bank statement as their financial information. It showed they had 99 cents at the beginning of the year and 99 cents at the end of the year, with a handful of in and out transactions. So what does that tell us about what they do? Not very much. When I asked them to resubmit their report, I could see they had rescued some 30 animals during the year using volunteers, and they explained that they wish they could have done more, but they didn't have the funds to do it. A full performance report illustrates to stakeholders that this group is active and shows how much work they have achieved on next to no money. Preparing the performance report is also a useful activity for the charity itself, as it shows the importance of good record keeping, and they can look back on the year's work and see how much they have accomplished. This is an example of the Statement of Service Performance, which has been prepared using the template that the External Reporting Board developed. The template is optional and can be found on both Charity Services and the External Reporting Board websites. This example is for a Tier 3 fictional charity. Both Tier 3 and Tier 4 need to provide information about their outputs. Outputs are the specific activities the charity undertook during the year. So for this example, the outputs are antenatal courses and Great Start parent courses. This charity has measured these with number of classes and number of attendees. Tier 3 charities are also required to provide an outcome statement. This is optional for Tier 4. This statement provides a high-level description of what your charity is trying to achieve. In this example, it is information and advice is available to help parents make informed choices for birth and parenting. Families receive postnatal support and opportunities to network with other parents. The outcomes are not a description of what you have done during the year, they are what you are trying to do. This can be a bit of a tricky concept at first, so it's a good idea to make sure you clearly understand the difference between outputs and outcomes before you start. You are not asked to prove that your outputs led to the outcome. Instead, the outcome statement explains why the activities are a priority for your organisation. When you are reading a statement of service performance, you should be able to make the link in your mind of how the outputs stated relate to the outcomes of the charity. You will notice there are some red asterisks on the example template. An asterisk indicates that the information is required. Asterisk. This means that you do not need to include your budget if you choose not to. There is also an exemption in the first year of using the new standards from restating your prior year numbers. So even though the last year column in this example has an asterisk, you do not need to complete this column in the first year if you don't want to. We'll move on to the financial information now. There are some specific parts of the Tier 3 and Tier 4 standards that are different from previous standards. We'll go through categories, recognition of certain transactions and related parties on the next few slides. But firstly, we'll discuss the basis of preparation. So essentially, what it means to elect a particular standard. Most people have had some awareness that there is now a requirement to include non-financial information in the performance report. But for some people there has been the misconception that in order to comply with the new standards, all you need to do is add a statement of service performance to an old-style set of financial statements. This is not the case, and therefore care needs to be taken when preparing the performance report, as there are certain financial components that need to be updated. It's important to recognise that Tier 4 is a cash standard and Tier 3 is an accrual standard, and therefore the way the information is presented is different. For example, you could not say you were adopting Tier 4 cash and then actually present the information like an accrual set of accounts. It's not a case of doing more than what the standard requires. It's a case of electing a standard that you are entitled to follow and then adopting that entire standard. For either tier, the steps to follow would be 1. Take a look at the Excel template so you can see how the report fits together. 2. Use the guidance notes to help you through the template. 3. If you still have questions, refer to the standard itself. And 4. If you're still stuck, ask a person for help, an accountant or charity services, for example. One of the key features for the new standards is that there are minimum categories for the money coming in and going out of your organisation. This slide shows the minimum revenue categories for Tier 3 and receipt categories for Tier 4. We are only showing the revenue and receipt categories as the expense and payment categories are relatively self-explanatory, and the questions we receive are usually about the income categories. You will notice there are subtle differences between the Tier 3 and Tier 4 categories. This is to reflect the fact that they are different ways of accounting. This includes the fact that capital receipts are included in the statement of receipts and payments in the Tier 4 standard in order to make the transactions balance to the bank account. The purpose of the minimum categories is to promote consistency across different charities and across different time periods for the same charity. However, it is acknowledged that some of the category names may not be the most appropriate for your specific charity, and therefore there is some leeway in the standards to alter the categories, which we will go into on the next slide. There is scope to tailor the categories to your organisation. However, it is really important to maintain the intended purpose of the minimum categories. The categories have been specifically written in order to give the reader an understanding of by how much the charity is self-sufficient versus reliant on external funds, and also give a sense of what the money raised is used for. For these reasons, it's important to maintain the integrity of the categories and not mix them up. For example, you must keep separate money received from members versus non-members, and you wouldn't mix up your income from fundraising with your interest income because they are in two different minimum categories. You will also notice that there is no minimum category for grants. This is intentional, and therefore you cannot just add a category for grants without thinking about what each grant was for. We will go into grants a bit more on the next slides because this is an area that has changed quite a bit. There are a couple of things to think about when recording grants. Firstly, you need to decide which category best fits the intended purpose of the grant. For example, if the grant was for general administrative purposes with no conditions, you would record it under donations, fundraising and other similar receipts, or in Tier 3, donations, fundraising and other similar revenue. As I said previously, you cannot just have a category for grants. If the grant was specifically for the provision of goods and services, for example, for food to put into the lunches of needy children, or another example could be a grant for a government contract for providing healthcare services, it would go into revenue from providing goods or services, or in Tier 4, receipts from providing goods and services, which makes sense as the money pays for the delivery of goods and services. Secondly, you need to decide when to record the grant. It's essential to know if the grant has any conditions attached to it, in particular use or return conditions. This means that if you do not use the grant for the specified purpose, you are contractually obliged to return it. If there are no conditions, you record the grant when you receive it. If there is a use or return condition, for Tier 3 you record the grant as a liability and then recognise the revenue and expense as the grant is used up. And for Tier 4, you recognise the grant when it is received, and you would list the unused portion as a commitment in your Statement of Resources and Commitments. The table summarises which category to record grants under and when you record the grant as revenue or a receipt. This is different from previous ways of accounting for grants, where you might be familiar with matching the grant income and expenses. This is a key change, so you now only record the grant as income in advance or a liability when there is a contractual obligation to use or return the grant. The Tier 3 standard contains a comprehensive table of when to recognise transactions and at what value. The guidance notes also offer additional explanation to help. I've just selected a couple of transactions which are particularly relevant and have been tricky in the past for charities trying to apply previous standards. The new Tier 3 standard makes it much easier in that you do not have to record things that you really can't find an appropriate value for. For example, donated clothes for an op shop. Charities are now required to report their related party transactions in their performance report. Related parties are people or entities that have significant influence over the charity, such as office holders, committee members, and others involved in the strategic management of the charity, and their close family members. Related party transactions are really common in the not-for-profit sector, and that's not a negative thing. It's really good to use your networks and get people to do things for your charity for less than you would normally have to pay. You need to disclose related party transactions if they are significant or if they are not significant but are not on commercial terms. Transactions can involve cash or non-cash donations, such as providing goods or services, also called in-kind. You need to include in your performance report a description of the relationship, a description of the transaction and the amount paid or received, and any amounts payable or receivable at year-end. It's a protection to a charity's reputation to clearly and simply state these kinds of transactions. I'll now pass you back to Amy, who is going to discuss the new audit and review requirements.
Thank you, Julia. So far, we have been talking about the standards developed by the External Reporting Board that guide your reporting to charity services. At the same time as this change, the Charities Act was also amended for the assurance requirements for certain charities. Some, but not all charities in Tier 3 will be affected. There are new statutory audit and review requirements being introduced to medium and large registered charities. These also came into effect from 1 April 2015. This new legislation defines which charities must undertake an annual audit and which ones must choose between an audit or a review. It also defines who can do that audit or review. So if your charity has operating expenses greater than or equal to $500,000, then the performance report shall be audited or reviewed. If your operating expenditure is greater than or equal to $1 million, it shall be audited. Under the changes, statutory reviews or audits can only be provided by qualified auditors. The legislation says a qualified auditor is a chartered accountant or a licensed auditor or a member of another association of accountants outside of New Zealand. This This table provides a summary of the reporting and assurance requirements. Please note the criteria for reporting and assurance is not the same. This is because the requirements for reporting and assurance are different. So at this present time, the Statement of Service Performance is not mandatory for Tier 1 and Tier 2 charities. The XRB does have a current exposure draft which intends to make this mandatory. So this exposure draft is open for comment. Comments are due to the External Reporting Board by the 29th of July, which is this Friday. In the exposure draft, the proposal is for a 2-year implementation period before the final standard is effective. This means that if we issue the final standard next year, it won't be effective until 2019. If you are involved in a Tier 1 or Tier 2 charity, we would be very interested in hearing your views on the exposure draft. The comments don't have to be formal. A simple email would be sufficient. So this exposure draft can be accessed from the External Reporting website. This document is called ED NZASB 2016-6 Service Performance Reporting. I'll now pass you back to Julia, who will provide a wrap-up of the webinar.
Thanks very much, Amy. So before we finish up today, we'll just let you know that there's plenty of additional help available to you. We have lots of guidance on our website, including videos, tutorials, templates and guidance notes, and I'll show you where to find it all on the next slide. People can help you too. Email or ring us. Our contact centre are trained to help you, or if they are unable to assist, they will refer you through to me. We need your questions because that is how we know what kind of information or guidance people need. This is all new to us. Please don't be shy. If you have, sorry, I should have said this is new to all of us. It's not all new to us. Please don't be shy. If you have a question, you can guarantee that lots of other people have the same or similar. When you come to our website, a few things to note. You can click on the menu or tab at the front page to go to information about the new performance report. This is where you sign up to our newsletter. Please sign up as this is how we can communicate new resources to you. You can also access my blog posts on the new reporting standards from the home page under Hot Topics. On the blog pages, you can sign up to receive notifications about future blog posts. So we're just going to go through some of the questions that we've received today. So if we don't get to your question, then we will be collating and publishing all your questions from all 3 of the sessions that we're doing on our website soon after the webinar. There will also be a recording of this webinar emailed to you within 24 hours, and once we finish the series we'll also be loading a recording of the webinar onto YouTube, and we'll put a link on the XRB and the Charity Services website. Okay, so the first question we're going to look at is about Xero. We've had a couple of questions about the Xero templates. If you have Practice Edition of Xero, or if you're connected to an accountant who uses the Practice Edition, also known as Green Xero, that's where you can find templates for Tier 3 and 4 which are compliant with the reporting standard. So that's a really efficient way of producing your performance report, and Charity Services are happy to accept Xero reports. Another question is, what if you have operating payments less than $125,000, but you have previously and probably will continue to use accrual accounting principles? In that case, you're more than welcome to use the Tier 3 accrual standard. You don't have to use Tier 4. You could use Tier 1 or Tier 2 if you really wanted to, but Tier 3 is probably a lot easier. The only thing to note with that is that if you're going to adopt Tier 3, you must adopt the entire standard. You can't pick and choose between Tier 3 and 4. Is it okay to prepare two sets of financial statements? A simple one that conforms to Tier 4 and is entered on the Charities website. The second set is for the stakeholders prepared as accrual accounting. If you really wanted to do that, you could, but I would think that that would be a double up of work. It probably would make more sense just to adopt the Tier 3 standard and use that for both purposes. You have to remember that the report you submit to Charity Services is publicly available on our website, so anybody can have a look at it, and therefore you might as well use the more comprehensive accounting standard. Can you please explain the asterisks used? I lost your commentary at the vital moment. Sure, so throughout the template, the Excel template, you'll see some red asterisks. That indicates that a field is mandatory. However, there is in the prior year column, there is an asterisk. However, there is a specific exemption for the first year of adoption that you don't have to fill out the prior year numbers if you don't want to. What the standard actually says is that you should attach your prior year financial statements to your current year performance report. However, if you've previously submitted to Charity Services, we'll have your previous year accounts on file, so we're not requiring people to do that. Is there a minimum number of service outputs that need to be reported? No, it's entirely up to you what is the most significant activities for your organisation. So likewise, there's no maximum either, but you possibly don't want to list every single little thing that your organisation has done. Just have a think about what your outcomes are, and relating to that, what are the most relevant outputs for those outcomes. If grants are provided to fund wages, how will this be classified? Generally, if it's sort of, say it's like administrative wages, then it would go into fundraising, donations and other similar receipts or revenue. If, for example, it was for a grant for wages for somebody who worked in an op shop, then it could arguably go under goods and services, but I think in general it probably goes under the first category. Sorry, I was just reading through a question. If I receive a $10,000 grant for airfares and it cannot be used for anything else, or it has to be returned, do I record the income as a liability? So when does it go through the profit and loss? So if you immediately spent it, you wouldn't need to record it as a liability. But if you say spent it a little bit in the future, then you might initially record it as a liability, and then you'd recognise in equal parts the income and the expense at the same time as you spent it. So, but if you received it today, spent it tomorrow, just record it as income and expense straight away. If you have expenditure under $500,000, you do not need to do a review. That is correct. You do not have a statutory obligation to do a review, but you also need to check your rules documents, so maybe your constitution or your trust deed, because quite often in those documents it says that the charity will have an audit or a review annually. Additionally, you might want to check if you're a recipient of grants, what the terms of those grants are, because sometimes funders request audited accounts as well. Do you have to use a qualified auditor if you are just choosing to have an audit, i.e. don't meet the requirement for a compulsory audit? In this case, can you just use a chartered accountant to complete the audit? Yes, that's correct. Qualified auditors are only for statutory requirements to audit or review. Does Ministry of Education early childhood funding come under grants? One thing I would just check with this one, just to make sure that you're not actually a public sector entity, in which case if you are a public sector entity then there's a different set of standards and they have slightly different categories, which does include government funding. So I'm not sure I've actually answered that question particularly well, so we might have a closer look at that when we collate the written answers. The trustees of our charity all incur many hours of voluntary unpaid time. Is this classed as non-cash donations for the purposes of related party transactions? It really depends if it's professional services that they're giving. So for example, if one of your trustees was a professional accountant and they were giving their services for free, then yes, that's definitely a related party transaction. Otherwise, you might just want to note in the performance report that the trustees volunteer their time. How many months or days following balance date must a charity hold its AGM and file its accounts with Charity Services? The specific date of the AGM will be different for different organisations and it will be in your rules, but you have to file your accounts with Charities Services within 6 months. So usually your AGM will be within 6 months of balance date. So we're just having a look through the questions because some of them are variations on the theme that I've already answered, so we're just trying to find a new one that we haven't covered yet. If revenue for a year exceeds $500,000 in a year due to a donation, but expenditure remains below $500,000, is my reading of the rules correct that an audit or review is not required as the threshold is based on expenses only? Yes, that's correct. So the tiers for reporting and the audit and review requirements are all based on operating expenses. Do committee members or trustees have to physically or electronically sign the balance sheet? Yeah. No, no, it's not a requirement of Charities Services or of the standards, but it is best practice. If I am a chartered accountant, can I do the audit of a charity that has expenditure of $250,000? You can, as long as you feel that you are I don't want to use the word qualified because that's got a technical term in the sense, but if you feel that you are competent to do that work, then yes, you can. But as a chartered accountant, you do need to be aware that you would need to follow the audit standards to do that audit, because under the Chartered Accountants Code of Ethics, one of the clauses is specifically that all the work you do must be in accordance with the External Reporting Board standards. That's the same for reviews as well. So there's actually a standalone review standard which is available on the External Reporting Board website. So just be careful, because I think Some people aren't aware that that standard exists, so if you're doing reviews and you're a chartered accountant, have a look at that standard. In terms of expenditure cut-off, if one year a charity is over 2 million and the next year it's under 2 million, do they adopt Tier 2 or Tier 3? So what you need to do is look back at the previous 2 years' expenditure. So for 2016, that means looking back at the expenditure for 2015 and 2014. And when it's been over 2 million for 2 consecutive years, that's when you would need to adopt Tier 2. Did I hear you correctly that the actual outputs for last year do not need to be included in the first year? So for the entire performance report in the first year of adoption of the new standards, you don't have to include last year's numbers, whether that's for the financial or the non-financial part. But going forward, so for 2017 accounts, you will need to have the comparatives for 2016 for both your outputs and your financial information. Funders often ask that financial accounts be audited. If you only need to do a review, is it likely that funders will adapt to the new reporting requirements and require only a review? We are having conversations with funders, and hopefully in the future they may adopt those standards, although we can't speak on behalf of everybody. Internal Affairs administers the Lotteries Fund and the COGS grants, and they have decided to adopt the $500,000 and $1 million threshold from the 1st of July this year. So our last balance date was, it says 31 December 2016, but I'm assuming the person meant 15. We're Tier 3 and have had our accounts audited and uploaded to the Charities website, but didn't do a statement of service performance. Do we need to retrospectively comply? So no, because the new requirements apply to periods beginning 1 April 2015 onwards. So for a 31 December 2015 balance date, the beginning of the period was 1st of January, which is before April. So no, you don't need to. Does MYOB have the reporting systems compliant to XRB like Xero does? Yes, it does, but again, it's in the version of MYOB that accountants have. It's called Accountants Office. We covered how to account for grants received. What about grants or scholarships going out? This is really easy. You just recognise them when they're paid, and there's a specific category for donations or grants paid, so you just put them in that category. Our operating expenses are $125,000 and we will be using Tier 3. Do we still need to have an audit? So the thresholds for which tier you're in are different from the thresholds for audit and review. So even if you're a Tier 3, you only have to have an audit or a review if you're above $500,000 expenditure. So the answer to that one would be no, unless it's required by your rules or some other, like a funder. We have been operating on a cash-based system, but a Tier 3, do we need to start using the accrual-based system to report? Yes, you do. Is it likely that incorporated societies will be using these standards once the law changes? So the draft New Incorporated Societies Act is out for comment at the moment, and one of the provisions in that Act is that incorporated societies will have the same financial reporting requirements as registered charities. So if you feel strongly either way on that, you should head on over to the MB website and have a look at that bill and make a comment on it. Do we have to fill out prior year numbers for a cash flow if a cash flow was not previously prepared? No, not in the first year of adoption. We have three separate parts and at the moment have an income statement for each and a consolidated one. Can we still do this? This is actually quite common in the not-for-profit sector. I would say no, it should just be one consolidated because you're doing the performance report for the reporting entity as a whole. What you could do is if you want to show the separate parts, so for example if you wanted to show the net profit for each part of your organisation, you could do that in the notes. How would honorariums be classified? Those would go under the employee and volunteer payments category. Are you looking for one key outcome or purpose statement or multiple outcomes? Again, it's going to be very specific to your organisation. So the example one that we looked at in the slides, they had probably two outcomes in that statement, and it's really the most relevant things for your organisation. So there might be 5 outcomes, there might be 1 outcome. It's really up to you. Just pick the most pertinent ones. What is a public sector entity? This is an entity that is listed under the Public Audit Act 2001, and the most obvious example of a public sector entity is like a government ministry or department. But in the context of charities, some schools are also registered charities and public sector entities. If you are public sector, then you most probably know about it because you will be audited by the Office of the Auditor General. Please re-explain the use and return condition. For example, what advice do we give to sponsors who provide us funds for awards? So the use or return condition is it would be a specific clause in the contract for your grant which says that if you don't use this money for the specific purpose, and sometimes it might have a time period on it as well, then you must return that money. So in terms of giving advice, I'm not really sure what you mean there because it will be up to the people who give you the money to specify the terms of that grant. Does an entity have to provide its annual report or performance report to any other governmental department that meets the Tier 3 or 4 category, for example, the Companies Office? So this would usually apply in the case of charitable trusts or incorporated societies, and the answer is no, you only need to submit it to Charity Services. Do these standards apply to small charity organisations that operate on less than $10,000 income a year? Yes, it does if they're a registered charity. So, and the tiers are based on the expenditure, not the income as well. The due date is 30th of September to submit the reports. Where do we submit it? So if you're a registered charity, then you will be able to log into the Charity Services website and there you'll need to fill out an annual return form which has some basic financial questions which you can get straight from the performance report, and then you upload the performance report. If you don't know your login or having trouble doing that, then just contact our customer support team and they'll be able to help you. If our charity's financial date is 31 March and we have up until September to submit our report, when is our next performance report due? So 12 months from then, so the September afterwards. Did I say that when we submit a performance report on the Charities Commission site for Tier 4, the statement of financial position does not need to balance? So for a Tier 4, you don't actually have a statement of financial position, which is also known as the balance sheet. Instead, what you have is a statement of resources and commitments, and that's just a list of the significant things that you own or owe. Because it's a cash standard, instead of a profit and loss, you have a statement of receipts and payments, so there's no retained earnings. So you're never going to get to the situation where you have a balancing balance sheet because there's no retained earnings to take over to the balance sheet. Can small charities access the accounting software for free and access a training to use the software? So by software in this context, I'm going to assume that you mean the Excel template, or maybe Xero or MYOB. So if you don't already use accounting software, then the best option would be to have a look at the Excel template first, which is on the Charity Services or XRB website. And on Charity Services website, we've also got a video which shows you how to use the Excel template. In terms of other software such as Xero and MYOB, I know that they do offer, the Xero offers discounts to not-for-profit entities, but I'm not really sure about MYOBs. How much detail do we need to write for the non-financial data, for example, objectives, rules of the organisation, if the constitution was already submitted to the Charities Commission in the past? Can we say, please refer to the constitution? The answer would be no, because it's not, you're not copying verbatim what's in your constitution. That's a legal document that has a lot of jargon in it. What you want to be doing is putting a plain English version of what your objectives are and how your entity is set up so that anybody reading it can understand who you are and what you're about. If my entity is a Tier 3 entity but controlled by another entity which is Tier 2, do I need to report on a Tier 2 basis? So the short answer is no, you don't. However, you would probably want to talk to the controlling entity and see what they would like you to do, because if you, say for example, both did Tier 2, then it might make it easier for them to consolidate. Just as an aside, when you've got this situation where you've got one entity controlling another, if you're both registered charities, we expect a performance report or a set of financial statements for each registered charity. So in that case, the controlling entity would submit a consolidated set and the controlled entity would submit a separate set. These long reports are going to bamboozle some of our older readers. Is there an option to produce a shortened version for them? We are Tier 3. Not really, no, because it's the whole purpose of it is to promote consistency across entities. So you can't sort of cut things out here and there. But I'll just give you an example. we had a performance report submitted the other day that wasn't done under the new reporting standards, and so I rang the lady up, and she was 83 years old, and I sent her the Tier 4 performance report template, and she rang me up and she said, how do I get it out of the computer? So I was thinking, oh dear, this is going to be a bit tricky. But once she figured out how to download the template, she actually completed the thing all by herself, and then she emailed it back to me and said, is this correct? And she'd done a brilliant job. So I accept that, yeah, it might be tricky in some cases, but if you put your mind to it, then it's achievable. We are both a registered charity and an incorporated society. Which of the two bodies will take precedence, or will we need to report to both once the new incorporated society reporting rules are adopted? No, you'll just need to report to Charity Services still, even if it's incorporated into the new law. We qualify for Tier 4 reporting and are using cash-based accounting. Are we able to still use the Statement of Financial Performance, Statement of Financial Position and Statement of Cash Flows rather than receipts and payments? No, you need to choose one standard, so either Tier 4 cash or Tier 3 accrual, and do the whole thing. So if you want to do Statement of Financial Performance and Balance Sheet and Cash Flows, then you're probably better going with Tier 3. Is it recommended for a charity with income of under 125,000 to report under Tier 3 accrual? So just to correct the question, it should be expenditure under 125 rather than income, but it's really up to you. It kind of depends on the number of transactions and what you have been doing previously. So if you've just got very small amount of transactions, so you might be better off with Tier 4. But if you're already really familiar with accrual accounting, then you can adopt Tier 3. Can we have a balance date and reporting date not based on 31 March? It's up to you when your balance date is. It will be included in your rules documents. If you want to change your balance date, then if you're, say, an incorporated society or a charitable trust, you firstly need to change it with the Companies Office, and then you can inform Charity Services of the change. So it's really up to your organisation when your balance date is. Where is guidance on what needs to be done when moving from Tier 4 to Tier 3 in terms of opening balances? So there are transitional provisions in the Tier 3 standard, but for this year, unless you've early adopted, you shouldn't be going through this scenario. So if you're adopting the new standards for the first time this year, then you don't need to restate anything. You don't need to do opening balances. You just start afresh. We are an animal charity and receive occasional non-monetary donations such as food. Are we expected to ascribe a monetary value and include that in our profit and loss account? No, but you might like to disclose it in a note that you have received those goods. Can you consolidate a Tier 4 into a Tier 3? Yes, you can, but you might find it a little bit tricky, so it might be easier to get both organisations to report on a Tier 3 basis. We are Tier 4. Do we need to deal with depreciation when reporting to Charities website under the Statement of Financial Performance? So if you're Tier 4, you're following cash accounting. Depreciation is a non-cash expense, so there shouldn't be any depreciation, and you also wouldn't have a Statement of Financial Performance. You've got a statement of receipts and payments that balances to the bank account. If you've got significant assets and for you it's really important to depreciate them, then you'd be better off adopting the Tier 3 standard. Our rules say we must have an audit or a review in accordance with the Financial Reporting Act. We are a Tier 3. Does that mean we don't need an audit or a review? So first of all, have a look at your operating expenditure. If you're over $500,000, then you would need a review or an audit. But if you don't, if you're below, then there's no requirement to, and if your rules say that it's in accordance with the Financial Reporting Act, then no, you probably wouldn't need to. It's actually quite a clever way of wording your rules. We actually have neared the end of the questions that we can answer easily live. So if anybody's got any further burning questions, please type them in now. If you have any questions that you come up with after we've finished today, then please email them through to Charity Services, because we will be answering questions after the session in the next few days. We are an incorporated society and registered charity, but have only been loading our accounts on the Charities website since 2008. Is this okay? Yes, it is. You don't have to file them with the incorporated societies if you're a charity. Is there any penalty for not loading these new accounts? I'm assuming you mean from a Charities Services perspective. So there are some pretty severe penalties under the Act, but that's only for really bad people. So there's a maximum penalty of $50,000 if you knowingly and repeatedly fail to file the correct type of accounts, but it would be very unlikely that we'll actually use that. Another thing that could happen is if you repeatedly don't use the new reporting standards and we contact you and you still don't do it, then you could be deregistered. That's a more likely thing that would happen. Is it mandatory to claim depreciation for Tier 3? No. Well, yeah, if you've got fixed assets, then that's when you would use depreciation, but buildings don't depreciate anyway. So so no, it's not mandatory. It really depends on your accounting policies. Somebody's just asked, why do buildings not need to be depreciated? I'm actually thinking of tax rules. So from, I think, 2011 it was, you can't claim depreciation as a deductible tax expense on buildings. So that's my reasoning for saying that. Can I just confirm, in year 1 of adoption, you do not have to restate your prior year comparatives? Yes, that's correct. You can if you want to, but you don't have to. We qualify as a Tier 4 charity using cash accounting. However, we did account for depreciation historically. Can we simply stop depreciating assets going forward? Yes, that's correct. So in your Tier 4 statement of resources and commitments, you just record the assets at whichever value you think is most appropriate for your organisation. So that might be either at cost or at net book value, and you just stop depreciating them. Okay, so we've reached the end of the questions. Like I said, a recording of this webinar will be emailed to you, and then at the end of the series, which is today actually, we'll be loading a version of this onto YouTube and putting a link on the XRB and Charity Services website. So thanks so much for your engagement and all your really great questions. and a massive thank you for all the work that you do to support your charities. It's really appreciated. Thank you.